Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody. Today, I want to do a show where I'm going to talk about the top 10 mistakes I see people who get involved in note investing make. These are very common and they're easily avoidable as well. So it's going to be an interesting topic where I'm going to spend the next 20 or 30 minutes educating you if you're a new note investor or interested in investing in a mortgage note fund on understanding some of the things that are easily avoidable that people make and tell you how we mitigate some of these issues. So let me start with number one on this list, which is skipping proper due diligence. Many investors fail to thoroughly investigate the due diligence, which it could be borrower's history, their financial situation, property condition, legal status of the loan. Perfect example is I saw on a website that I'm a member of, a forum post where an investor just went out and bought a loan, did not really understand the lien position, what the status of other loans were on the property, and we're just excited because it's like, I'm making my first purchase and it's only cost me $10,000. And oh, the seller of the loan is even going to finance a portion of it. All red flags, but this is a situation where see an investor rush into a deal and not fully understanding that background. It's really actually very simple to avoid. We have an acquisition process. We are a very SOP-driven company where we have standard operating procedures. We have a comprehensive due diligence checklist that we follow and go through. This includes ordering property inspection, reviewing title reports, ensuring the loan documentation is validated. Then we have an attorney review that file, especially if the loan's in default. Again, we want to mitigate the risks. If people want a copy of that due diligence checklist, we actually provide it to investors and provide it to people out there so they understand kind of what we do and how we go through this process. And to me, this is something that could be easily avoided, but people just get this FOMO and just want to rush into some of these assets, or they believe what the seller is telling them, which is something that you never want to do. A lot of times when you skip that due diligence kind of leads to, what I'll say is second on this list, which is people overpaying for mortgage notes, especially non-performing loans. And a lot of times they may not account for potential foreclosure costs, the legal fees, the property condition. People don't want, in many instances, when this happens, people don't have a clear criteria to ensure they're purchasing the note that fits their model of what they want to make on these loans. And many times it's really just investors not knowing. Don't understand what it costs to foreclose on a specific state. They don't understand how long it's going to take. They may go online and say, oh, it's going to take 6 months to foreclose. Oh, yeah, it might take 6 months to foreclose, but also that's just a foreclose. Then if it's occupied, you might spend another 3 to 6 months of getting that borrower out of that property if you do actually end up foreclosing. Or in this instance, they end up filing bankruptcy and that wasn't an exit strategy a person considered, so they overpaid based on a certain exit strategy that didn't come to fruition. This is why it's important to understand how to model and understand all the costs when acquiring a note. Because many people, again, just listen to a guru that says pay 70% or 50% or pick a number. That's not the right way. That's like going in and buying a property at foreclosure auction, just saying, I'm going to buy everything at 70 cents on the dollar without knowing how much it's going to rehab. That was a good example. So something we see often, there was actually somebody on a LinkedIn talking about what they're paying for a note, and they're paying like $150,000 for like a $170,000 loan. I'm sitting there scratching my head, and I'm like, it's like no money in this deal at all. Like, what is this person doing? And sometimes when somebody gets money, they're like, or if they're, especially it's not their own money, like, oh, I'm just going to get it out the door to show this person that we bought a note. Worst thing that can happen. Understand, you shouldn't overpay. And a lot of these investors, unfortunately, don't even realize that they're overpaying for the note. And again, these all tie together as we roll into number 3, which is the reason why many people overpay is because mistake number 3 is they don't understand foreclosure laws in the state where the property is located. Some states may have a lengthy and costly judicial process, which can erode returns. For example, we use Philadelphia. Now, I've had attorneys recently tell me don't even bother investing in Philadelphia because even if you foreclose, the sheriff to ratify that sale is taking up to 12 months. Understanding the laws, talking to attorneys. You got to do research. That's the easy way to avoid this. Understand the timeline, the costs, and speak to attorneys. Don't just go off of what you read on the internet. I can tell you right now, there's people out there who are providing all this information to investors and not even buying loans. But how do they know? Owe attorneys monies that they're not even paying attorneys for money they owe them from 5 years ago, but they're out there telling you, here's what it's taking. They have no idea because they're not doing it. So understand when you're getting your information, get it from somebody who's actually going through that process. But again, a lot of people miss this step and they just go off of what they read on a Facebook forum. And it's so critical to consult with attorneys on a state-by-state basis because it is a judicial state. It can take much longer and it can cost significantly more. And if you don't know this or account for this, goes back to number 2, which is just essentially you overpay for the note. Let's roll into number 4. All of these kind of tie together in some way, shape, or form, because at the end of the day, mistakes people make are essentially they lose money on a deal because of not understanding these things that we're talking about. And what we kind of just mentioned is, with the foreclosure timelines and costs, which ties into 4, which is underestimating the cost of non-performing notes. They underestimate the cost of the legal fees we talked about, the foreclosure fees, but also property repairs. What is it going to take to get this property into a sellable condition? Property taxes. Did you account for property taxes? Did you account for holding costs if you have to take this back? You need to be conservative in your modeling. You can't be too conservative that you're never going to win a bid, but you need to understand that there's default servicing from your servicer. That is going to be approximately $100 a month. If they file bankruptcy, there might be double fees from the servicer. Again, you have property taxes. What about insurance? Did you account for insurance and the skyrocketing costs of insurance? All of this can be found out back in number 1, which is that due diligence process. It's so important that people understand the costs involved. And then if somebody understands, the property is worth $300,000, you take it back at foreclosure, well, guess what? Now you have to sell it. Probably going to have to pay a realtor. Probably have to pay closing costs. So you're not netting the full $300,000. And did you account for $5,000 to $10,000 in trashing that place up and getting it cleaned to at least even get it presented? So as you can see, lots of costs that you need to know about. And a lot of newer investors don't even know these costs exist. So it's important to not only understand the cost of every cost that could be incurred, but also the estimating it properly. Next is lack of diversification. And this is very common as people get started because people will put all their capital in 1 or 2 notes. Another term is called concentration risk. And if one of those, if it's a performing note and it defaults, chances are you're not going to probably do very well. Or if it underperforms, it could have seriously impact on your portfolio. So this is a tough one to avoid because it depends on how much money you have to invest. You have $100,000, okay, maybe you pick up 3 or 4 loans at $20,000 to $25,000 a piece. Okay, you can make it work. But people who have $10,000, $20,000, I know they want to get into the game, but it's going to be very challenging. Now, I got into the game with under $50,000, but this was also 8 years ago. So there was significant inventory of loans under $25,000 to $50,000. I could buy 100 loans at $10,000 to $20,000 easily back then. Today, it's very challenging to find those, and if you do, you're typically on land. The other area of diversification is geographic. Understanding, put all your eggs in one city because there could be an impact there. Understand whether it's judicial and non-judicial. And then also your type of loans. Are you buying all performing or non-performing loans? Diversify. For me, I would tell people to invest in a performing loan for your first loan. And the reason why is, which leads us to number 6, is failing to understand loan servicing and what a loan servicer is, the importance of that servicer. And this was a mistake I made early on because I didn't realize when you board a loan how painful that process can be, where unfortunately I was also using a company that's probably the worst in the industry at boarding loans. I think we were several months in and they still didn't board the loan. And to this day, I won't use a servicing company, even though they're pretty large. But you need to understand what the servicer does. How do they handle borrower communication? How do they board a loan? How do they process the payments? And also, they don't manage your note. That is the clearest thing people need to understand. They are there for you to manage them. Their job is to collect the payments, and if the borrower is not performing, to call them to see and get them to make the payment. There was a recent post on Facebook that somebody asked the question, hey, loan services, what are you doing about the flooding in Asheville to, get in touch with borrowers? Because there's no power or phones. And I pushed back on this person and asked, what do you expect them to do? You hire them for a nominal fee to call people, and they mail statements. They keep you compliant. But if you want to send somebody by the property to see if it still exists, that's on you. You need to tell them what it is that you need or that you want. You are the ones, if you're the puppet master, you're the puppet master pulling all the strings. They will do what you tell them to do, but they're not going to do something out on their own. They're not going to say, oh, there was a flood, so let's send people out there to go take a look at these properties. Because you might have already sent somebody or used somebody else and then tell them, well, I'm not going to pay you for it. Again, people need to understand servicers ensure compliance with regulations, and they manage the payments, they communicate with the borrowers, and they reduce the burden on you, but you still have the burden to manage them. So it's important to understand that loan servicing, because some people think I buy a note, the servicer does anything, and I can just be passive. Not the case, people. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at 7E, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@70investments.com to learn more. Thank you. Next, lucky number 7 is expecting immediate returns. There are gurus out there that will tell you can make $250,000 in your first year. And they'll tell you that you buy a $50,000 note for $25,000. You get that borrower to give you 6 months of payments at $5,000. Then you turn around and you sell that note for $40,000 and you get your $25,000 back. Plus you made an extra $20,000 or $25,000 on that loan. So it's, wow, you doubled your money. And if you do that 10 times in the first year, you're going to make $250,000. That is the dumbest thing I've ever heard. Just like running a business, it's going to take a period of time to make money. Now, can you get lucky and hit a home run early on? Of course you can. But if your expectation is make quick profits, especially on non-performing notes, it's not the name of the game. It's patience, especially when dealing with these distressed assets. Having this expectation, understanding that when you buy a loan, especially non-performing, let's say I bought a loan today. I'm recording this mid-October. That loan's not going to be boarded, most likely, with the servicer until Thanksgiving, hopefully, because you got hello and goodbye letters and everything else. Let's say December 1. Then it's boarded. Then you got to give them 30 days to allow for that transfer. So now you're at January 1. And let's say the borrower's behind. Then I can send a demand letter January 1, which realistically is going to take 2 weeks to get organized and have your attorney send it. So January 15th expires February 15th. Then you start the foreclosure process then. Maybe you file by March 1st. And let's say it's a non-judicial state that gets you it in May. Okay, so you're in October, November, December, January, February, March, April, May. 7 months. Boom. Already. That's the fastest. So people are thinking that they're going to get immediate returns. Not going to happen. Just understand the average life cycle of a loan is 12 to 18 months. And typically it can be longer. I've had some loans that have been going on for 4+ years and still fighting or disputing things, I should say, with the borrower. So for those that are expecting that immediate home run and every deal is a home run because that's what people show you, sorry, not the case. For us, and we've said this many, many times, we like to target the singles, the doubles, the triples. We don't like to hit, it's not that we don't like to hit home runs. We don't swing for the fences because when you swing for the fences, you can strike out. Number 8, still a sip of water here. Overlooking the importance of title reports and lien position. And this one's really interesting because, man, oh man, this is probably one I see the most, and people don't understand. Well, I'm in first, but there's also 2 other liens behind you. I'm looking at a loan right now that this one's a crazy situation that the first position, it's got 3 loans behind it, and the borrower's trying to sell the property. So somebody looks at it and says, oh, the borrower's selling it. It's got its sale pending. So great, I'm just going to get paid off. And no, you're not, because the sale of the property is not going to satisfy those other lien holders. So they can't sell a property. You're going to have to foreclose. You're going to have to wipe out those other liens. The borrower could file bankruptcy as well. But it's a mess. When it's a mess means time. Another mistake is, so here's a true story. We bought a portfolio, this is 2018, of 80 assets. And the seller said, hey, I already got like 10 of these under agreement with other people. Can you just manage it and sell them so the seller doesn't have to do all these other assignments and stuff? And basically, if your bid was lower, hey, you can make a few bucks on them, which basically pretty close. We really didn't make anything on these, but we're like, okay, we're just going to transfer the day of the sale. And I told these people, hey, look, I'm doing no due diligence on these. Literally that you got to put the funds in escrow and we'll do a double closing. I'll close with the seller, then turn around and just close with you. So everything's issued same day, so forth. And this buyer, buying a performing loan, didn't look at the title. Didn't even order title. And it was actually a property that had 2 parcels attached to it. And the servicer was screwed up and did not pay the taxes on the second parcel, which I think housed like a garage. So a week after this person bought the loan, that second parcel got sold at tax sale. And then they came back at me and said, this is my fault and that I need to make it right. I said, what do you want me to do? You didn't do your due diligence. You should have paid the taxes. And he's like, well, no, you should have paid them. I'm like, why? I literally owned the loan for about 7 minutes. And I'm sorry, but kind of on you. This person to this day still does not, I think, like me because of it. But it goes back to, you would have ordered a title report. You would have saw that there were past due taxes that were going to sale because it showed up on the title report because the person ordered a title report after the fact and then had the moment. So understand the importance of title and lien position. Also, in regards to this, see a lot of people doing lending, and here's a true story. We have a first position loan on a property in bankruptcy. A woman gave this borrower who was in bankruptcy, I think it was like a $50,000 loan. Didn't do any title investigation. Didn't even know this person was in bankruptcy. gave them the loan. It's unsecured, and the person may have used it to like buy new cars. I mean, it's basically, the person didn't use it to pay us. I know that much. But now this person realized that they're out the money. And they're like, oh, what did I do? They gave this person money that, fortunately, it's probably going to be completely wiped out. Because, unfortunately, they didn't understand what they were doing. Okay, as we round out the final two, they kind of tie together. Number 9 is not having an exit strategy, where people just go into investment without a clear plan. How are you going to exit? Especially if it doesn't perform as expected. I mentioned that person that overpaid. Their whole theory was, I'm going to get this borrower to do a reverse mortgage and pay me off. Thinking, do you know how hard it is to get a reverse mortgage underwritten and done? And then explain to somebody who's in their 70s? It is hard. It ain't easy at all. And if they have family members, it even makes it harder. But that was their only exit strategy. If that strategy didn't work, toast. But also, people will go into, I see this a lot in private lending. They'll give somebody a loan for a property, and the person got all this equity, but they failed to ask the question if do a 12-month loan. How am I getting paid back in a year? What are you going to do to pay me back? And they'll understand there isn't an exit strategy. Now, as part of any loan, you need to plan for these various scenarios. If I have to sell this to another investor, what's it look like? If I have to modify the loan. Read last night, Facebook post. Somebody can't sell their house. It's like, I'm going to do it seller financing because I think I can get more money, and I'll do a loan to this borrower at 6% and sell it back on the market. And this is what kind of rolls into the last one, which is lack of understanding note evaluations. This person doesn't analyze the exit strategies, or they come up with one, but then they don't understand the valuation, which is number 10 on this list. Because you're going to sell a note at 6% on the secondary market, that's going to sell for 50 to 60 cents on the dollar. So I'd rather sell my house for 10 or 20,000 less than write a $200,000 loan at 6%. That's probably going to sell for 120 grand. Do the math. Which one would you rather do? $20,000 or $80,000 deduction? People go into these situations, especially today, because again, gurus telling you creative finance, seller finance is the way to go. They don't understand how to value a note. They're giving people loans at 130% loan to value of the property. And then they're thinking, oh, I'm going to be able to sell this for 90 cents on the dollar. No, you're not. You're writing a loan for 130 and property's worth 100. Most investors don't want above a 75% LTV. Or you're going to pay for that risk, means you're going to discount it more. So a lot of times people focus too much on the face value, or they've got this one exit strategy tied in their mind and don't understand what it is. Another example, Facebook. Again, tell people, whoever looks on Facebook to buy loans, you're never going to buy one on Facebook. Somebody offering a $280,000 loan at 4%, and they wanted more than the unpaid principal balance. They wanted 300 grand for it. And other people picked up on this too. And the people were like, send me more information. I'm like, send you more information on what? You have no clue how to evaluate that loan. And what this investor was thinking is, well, the loan has $500,000 in total payments, so that's how we calculate it. So that's like buying a CD that's going to pay you 5 years at 5%. Let's say it starts at $50,000 and ends up at $80,000. That's like saying, oh, I'm going to give the bank $70,000 for a $50,000 CD. No. The risk-free rate is actually higher than what this note was written at. This note is pretty much at 280, worth 100, 140. And they're trying to get 300 for it. So if that person did seller financing thinking, oh, I'm going to do great on this, they're toast. So it's so important to understand how to value these notes. So those are 10. I could probably go on and list another 100. I just wanted to kind of give you the top 10 that we are seeing today in the space. And it's important to understand. Also, if you're looking to invest in an offering, for example, if you call us up and want to understand notes or how we evaluate ours, we can tell you all the dirty little details, but you don't, as an investor, passively may not understand everything we say, but you should at least listen, because there's a lot of debt funds out there today don't know how to buy debt. So when you ask them, well, what's your exit strategy? What are you going to do in this? Be curious to see what they say. As always, Thank you for listening, and make sure to leave us a review on your favorite listening station. I am Chris Seveney. Take care and enjoy. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.